The topic for today is open market operations. We will discuss the method of operation. I would recommend that I have made other articles on open market operations. First, please go through those very nicely and understand what actually is open market operations. Today, I will be discussing an example with the graph regarding the method of operation. See, there are two main principal motives of open market operations. The first of motive of OMO is considered to influence the cash reserves of the commercial banks. Now the RBI eyes on the reserves of commercial banks. If RBI wants to increase the reserve or decrease the reserve, OMO comes into operation. So how will you affect these reserves? These reserves will be affected by OMO, right? Now, when we influence the reserves, that is either we increase them or we reduce them, what is the basic motive? Ultimately, the motive is to control the power of credit creation of the commercial banks. Commercial banks' credit creation depends on their reserves. If the monetary policy of a country alter the reserves of commercial banks, that means we are altering the credit creation of commercial banks. Second motive. The second motive of OMO is to affect the market rate of interest. Now the monetary policy has so to be framed that through OMO we are going to influence market rate of interest. Ultimately, the motive is to control the commercial bank credit. In a way, when we will be influencing the market rate of interest, we will be reaching what? The commercial bank credit. Main eye is on the commercial bank credit in both these motives. Let's move forward. We will be discussing at length the method of operation. First is in the case of inflation. Let us assume that there is inflationary pressure in the country. The central bank will naturally want to control this inflationary pressure. Central bank wants to combat the inflation. So what it will do? The commercial bank wants to control what? The expansion of credit by the commercial banks. Now to control this inflationary pressure, what we have to do is the central bank will control this credit expansion by the commercial banks as I discussed in the motives. We have to combat, we have to put a control, put a bar on the expansion of credit in order to control inflation in the country. Let us further assume that the central bank sells the government securities worth 10 crore. Very simple. Central bank comes into OMO and it will sell 10 crore government securities in the open market. The public pays the central bank because the central bank has sold these securities. So the public will have to pay the amount of those securities to the central bank. The payment will be by the way of checks drawn against the commercial banks. We assume that people don't have that much of cash in hand. They will be paying, this payment will be through checks. Now when commercial banks will be clearing those checks, the cash ratio of commercial banks will be naturally affected. They have to undergo a change in their balance. The cash ratio of commercial banks will go down by 10 crore because the securities has been sold to the value of 10 crores, so the commercial bank's cash ratio goes down by the same amount. Hence, the commercial banks are automatically forced to curtail or reduce their lending, right? Because the treasure goes down by 10 crore and their business is to lend. Now, you can't do the lending. You have to reduce the lending to the extent of 10 crores. So, this is how the function happens. Now let's take an example. It is assumed that initially the commercial banks have assets valued 1000 crores. The cash deposit ratio is further assumed to be 10. This implies that 1000 crores get split in 100 crore cash and 900 crore as loans or deposits. You know the meaning of cash deposit ratio? Out of this much they have kept them in cash. The commercial banks keep this much in cash and this much they use for lending or deposits. Therefore, when the central bank sells the securities worth 10 crores, the cash is reduced by 100 crores because the ratio will get multiplied, right? Hence, the amount of cash which remains with the commercial banks is now 1000 minus 100 crore, which reaches 900 crores. So ultimately, when the central bank sells the securities, they are able to control the cash reserves of the commercial banks, and indirectly they keep an eye on the expansion of loans by commercial banks, on the expansion of credit by the commercial banks. So ultimate aim has been reached by the central bank. By selling the securities, it is able to keep a taboo on commercial banks. Further, now see, the reduction in the cash holdings of the commercial banks will automatically cause a decrease in the supply of the bank money. Very natural. As we saw, that much crores cash will go down. Here we are considering the figure in which bank money is shown on this x-axis and the interest rate is shown on the y-axis. S is the supply curve of the bank money. This S is the initial supply curve of the bank money with the given rate of interest small r. Now S curve shifts to S dash, which means that the decrease in the supply of bank money from B to A given the rate of interest R. See, the bank money initially before the commercial bank sold any securities was at this point B. Now, as we saw in the previous slides, when the central bank sold the securities worth 10 crore, we came to the conclusion that the bank money has reduced. It came from B to this point A. Due to this event, the supply curve of the bank money also shifts inward from S point to S1 point. This indicates that there is a decrease in the supply of bank money. And this is what ultimately RBI wanted. RBI wanted that the bank money should be reduced. If the bank money is reduced, they will not be able to expand more credit. And it was very successful in reaching its motive with the help of OMO. So this is how the method of operation takes place. Let us move further. Now what happens during the recession? When there is recession, the central bank aims at expansionary policy. Now the method will be altogether opposite to what was there in inflation. There it was a contraction policy, and how? Now central bank would like to expand the policy. How will it do it? The central bank will purchase the government securities from the holders of such securities. So it jumps in the open market and purchases the securities and bonds. The central bank will pay the sellers through the checks. Obviously, the payment now has to proceed from the central bank to the public. The public, when it will receive these checks from the central bank, it will deposit these checks in their respective accounts with the commercial banks. Very natural, all the money in the form of checks will ultimately go in the hands of commercial banks because people have their accounts in the commercial banks. As a result, commercial banks undergo increase in the balance. See, ultimately central bank applies the magic wand and it is able to achieve what it targeted at. Because there was a recession in the economy, central bank wanted to increase the balance with the commercial banks so that they get more liberty to expand the credit to overcome this recession. This is how the central bank moves in a way to increase the balance of commercial banks. Next. See, now what will this graph undergo this change in the period of recession? Therefore, the supply curve of the bank money shall shift from S to S2. We saw when there was inflation, the initial supply curve of the bank money shifted inwards to this S1. But now, because commercial banks will receive more money, their balances of money will undergo a increase Therefore, this supply curve of the bank money, it will shift outward to S2. Actually, the supply of the bank money, which was at point B, will now move to point C. With the increase of the bank money, the supply curve also comes to S2, right? Now see, it is evident that the supply of the bank money moves from B to C, just I mentioned right now. As a result, the banks will now lend more money at the given rate of interest R. And this is what the central bank wanted. It is successful in achieving its motive, right? Next. See, OMO has direct influence on the market rate of interest. Due to OMO, the supply of money changes. We just discussed it at length right now. This in turn, now what this affects changes the market rate of interest. Let's see, when the sale of securities happen by the central bank, decrease in the supply of bank money happens, which leads to rising the market rate of interest. So when the central bank will sell the securities, the bank money with the commercial banks will decrease. Supply curve moves inward, which in turn will raise the market rate of interest. And this is what exactly happens here. When the central bank purchases the securities through OMO, what happens is the increase in the supply of bank money, which will reduce the market rate of interest. So here we come to the end of the article. I hope I have made the things very clear and you understood it very nicely. Please subscribe to my channel. Do feel free to ask any doubts regarding this topic in the comment section. Thanks for watching. Stay safe, stay blessed.